Good afternoon, ladies and gentlemen, and welcome to the Good Energy Group PLC full-year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and will publish those responses where it's appropriate to do so. Before we begin, we would like to submit the following poll, and if you would give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand over to Rupert Sanderson, CFO, and Nigel Pocklington, CEO. Good afternoon to you both.
Well, thank you, Mark, and a very good afternoon to either current or prospective shareholders in Good Energy Group, and welcome to our preliminary results presentation and a discussion of our strategy from here. So to give you a sense for what to expect over the course of the next hour, I will make some introductory remarks and hand over to Rupert, who will take us through last year's financial results, and then I will take over again to discuss our future strategy and in more detail, and then there will be time for both pre-submitted questions and questions that come up live from the meeting after that, and we will wrap up at the hour mark. It's worth starting really by saying that I joined Good Energy in May of last year, and it has been a somewhat eventful time since then. We have seen a takeover bid and subsequent requisition general meeting. We have seen an extraordinary energy crisis, which is really reminiscent of the 1970s oil price shocks in its magnitude and economic and social impacts. And it has been therefore a very busy time for both me and the team at Good Energy. In the background, we have been working on our strategy, and this is really the first opportunity I've had to talk to investors about where we see the business going from here. And in a nutshell, this is where I see it going. So Good Energy's mission, which has always been and remains to power a cleaner and greener world, I think still holds. It was always a very motivating mission for the company, customers and shareholders, and that remains the case. What I am now saying is that our vision, our ambition for the next few years is that we should want to support 1 million homes and businesses in cutting carbon from their energy and transport use. And that million is an important figure to understand, and we'll come back to a lot, because it refers not just to supply customers for our renewable supply proposition, but also to customers and users of our energy services business, which is where I see potential for higher growth and greater reach for Good Energy, and therefore a greater chance of delivering on our mission. And I'll unpack a bit more later about how we see that working. It's worth recapping on something that happened in the recent past once again, though, to start on this, which is this is enabled by something we do see as a transformational moment for Good Energy, which is the sale of our generation portfolio, which we announced the process of in November last year and completed in January of this year. That is transformational because it frees up well over £20 million of additional capital for us to both invest in our future and also to buffer ourselves against these shocks coming from the energy market at this point in time. It also makes us look like a very different company to the outside world. We are a company without any debt. We're a company with cash on the balance sheet, and I think that leaves us in far better shape, frankly, to both weather the storms and invest in the future. So that was a key moment in Good Energy's history. So what does that leave us, and what sort of business should you be thinking about? Well, I think it's a business you should think of with 3 legs in the stool. First off, remains our commitment to be a supplier of 100% renewable electricity, priced as fairly as we can manage, and managed in a very transparent manner in terms of the sources of that fuel. That continues to be something we regard as the sort of essence of Good Energy, if you like. But there are 2 other areas where we're also going to be focusing increasing amounts of resources and investment. The first is on decentralized energy. Again, in some ways, that is part of our history as one of the leading movers behind the feed-in tariff scheme. But we are absolutely focused on building new products and services which help people to both generate their own power store it and share it. And then lastly, we see movement towards e-mobility as key in terms of the UK meeting its climate goals. And we want to make that transition as easy and quick as possible. And therefore, we are continuing to invest behind electric mobility, making it easier for people and fleets to own and drive and fuel their electric vehicles. So those are the three areas we're talking about later on in terms of the future of good energy. It would be remiss not to offer some sort of context for both the financial results and the strategy from the energy market. This will be very familiar to a lot of people, frankly, but just to recap, the dotted line in the green there shows the electricity price, the wholesale price of electricity as we track through 2021. As you can see, a considerable increase in that price in the second half of the year, particularly in the latter part of the year in Q4. That spike in wholesale prices then sent a shockwave through the electricity supply market in the UK. 28 suppliers, that's 60% of the field, failed in 2021, largely because they had failed to hedge appropriately and therefore be able to deal with this kind of price spike, or they didn't have the financial resources, if they weren't that hedged, to deal with that sort of price in the wholesale market. And it is in that context that I think Good Energy is a very prudent approach towards energy purchasing, and the strength of our balance sheet has stood us in very good stead. But it is a very different supply market as we exit 2021 than we came into. And, well, how is that likely to turn out? Well, if I knew the precise details of this, I might be in a different type of job, of course, but I think worth stressing that our projections for this year and our future plan are made in the background of a very high energy price, evidence of volatility in the energy market. You can see the spike in December there, and an even greater spike at the start of this year as the implications of Russia's invasion of Ukraine really became apparent in the wholesale market. Things have calmed down a little bit, but they've still calmed down at a very high level. We can't rule out future shocks, which means an emphasis on the prudence in our hedging and again on cash and strength in our balance sheet will be important as we navigate 2022. And after one of the more interesting years in terms of the wholesale energy markets, I'll hand over to Rupert to explain how that plays through the company's financial results. So you have control.
Thank you, Nigel. Good afternoon, everybody. So I'm going to summarise the financial results in the context of the very challenging market conditions we felt, particularly in the second half of last year. Our performance has been resilient, and it's a word we use quite a lot within our sort of external market reporting that we put out this morning in the face of multi-supplier failures during the second half of 2021 in particular. The company is now net debt free, and that's a substantial change from those of you who followed this business over the last 4 or 5 years. We have pricing flexibility in both our domestic and our business supply segments, which enables us to see a way through to a positive working capital position through the cycle of volatility in the commodity prices. And the net proceeds that we've now received of a little under 20 million pounds on a net basis at the start of this year give us the financial flexibility, which I think Nigel describes in terms of a balance between navigating continued volatility in the energy markets and looking forward to investment to support our strategic growth plans. So if I just start on the income statement, and this is quite a confusing set of results given the way we have to account for effectively the change in the business structure that has happened after the end of the year, but we announced late last year. So the way we have to present this is as the supply business, which is of a continuing nature, so we continue to operate that business. The whole of the generation segment is treated as discontinued, and that effectively means that the performance is completely split, and therefore it is quite hard to understand the performance of the business from the top to bottom of the P&L account. So I'm going to start with the top of the P&L account, and then I'm going to go over leaf and try and explain what we believe to be our sort of underlying performance when you put those two parts of the business back together again. So revenue is up a little bit under 12%. The drivers of that, we've had a small amount of growth in customer numbers in all of our segments. We've had electricity supply volumes up by nearly 15% year on year, and much of that is driven by recovery of business volumes. 21 was impacted by COVID, but to a much lesser extent than those very initial sharp falls in activity and demand in the second and third quarters of 2020. Gas demand is up about 5%. Most of our gas demand is domestic, so there's less impact associated with the business dynamic in that area. We put up our prices right towards the back end of last year in both some of our domestic and SME segments, and we've made a second change to our standard variable tariff in early 2022. So I would expect to see revenue growth, all else being equal, to be considerably stronger in 2022 than in 2021. Cost of sales has risen more sharply than revenue, and this is really down to the sharply increasing commodity prices in the second half of the year. The sort of market stasis within the energy supply retail market, so switching stopped, so we ended up with more customers than we expected to have, and therefore having to buy power and gas for those customers on the short-term markets at very high prices. And as I think we described in both, predominantly in the latest trading update we gave in December of 2021, the low wind generation across the portfolio of PPAs that we have led to, again, the need to go and buy additional power for those customers in that period of time. So we see a much sharper increase in cost of sales than we do on our revenue line. And I'm going to move on from there and then try and explain our profitability by way of a bridge. And I apologize that this is very busy. I'm not going to go through every number. I would call out that the black bars are data points, so those are physical values, and the yellow bars are movements. And I'm going to predominantly concentrate on the first 2/3 as I go from left to right. So this is to try and articulate the underlying performance of the business as if it had looked as one from our financial reporting in 2021 and compare it against 2020. So the first yellow bar is around volume. So that additional volume, particularly in business, and a small increase in domestic volume, is a positive profit contributor year on year, a little over 2 million. The biggest financial impact, which I touched on the previous slide, is the low wind. It's the additional power and gas we had to supply for customers we didn't expect to have. And it is the sharply increasing prices of that power and gas in Q4 in particular that's led to an adverse movement in the year of £6 million. We continue to invest in ZapMap more significantly in 2021, and so that is a additional loss within our overall P&L account year on year. Although and I'll touch on collections a little bit later, but our performance in the second half of the year, particularly around maintaining and improving the level of collection activity from our business and domestic customers, was better year on year than in 2020. The big yellow bar upwards, so £5.9 million, this relates to how we have to present the business externally in terms of that continuing and discontinued split. So this relates to the power that our generation portfolio, which we still held at the end of 2021, the power that was supplied to our supply business. And for the purposes of our external reporting, the power that was supplied to our supply business isn't included within our supply business result, which feels like a accounting anomaly, but that is the way in which we have to present it. So externally, you will see a figure of £2.6 million worth of profit attributable to our continuing operations. I don't think that fairly reflects the performance of our business. So this then reverses out that elimination, brings in the operating performance of that generation portfolio over the course of 2021. That is the 0.5 million pounds worth of profit contribution, bringing us down to an underlying outturn of minus 2.8 million pounds. And that, I believe, is the fair representation of how the business performed in those extremely challenging conditions in the second half of 2021. We touched on this right at the start. So going back to 2018, this business had net debt of over 50 million pounds. We are now net debt free, and we have a small remaining amount of external debt, a little over 5 million pounds in Good Energy bonds. So that is the only remaining material debt within the business. So a substantial change in the structure of the business over the course of the last 4 years. On cash, I think there's only a couple of things again here to call out. At a cash generated from operations level, we are cash generative, but year on year, we've seen a decline of a little over 6 million pounds in that performance metric. That's very much linked to the increase in commodity costs in the second half of the year. The market stasis led us to have to buy a lot of power and gas on short-term markets, pretty much at spot prices, pretty much on delivery, and therefore we've seen that actually flow out in cash in the second half of the year. And the second point we've touched on before again was and I think we've touched on the interims, was the repayment of 12 million pounds of Good Energy bonds too. So our cash moves downwards from 2020 to 2021, however, with the repayment of a significant amount of debt. And coming back to collections, the strength of collections we have seen since October is really down to three main drivers. Again, at the interims, I think we were talking about the implementation of our NSEC billing system, and as the migration of accounts to that new system, there were some delays in billing and delays in cash collection, which were now substantially caught up. We've put through significant price rises in both the domestic and SME segments in the second half, late 2021 and early 2022, and we would expect and are expecting to see that come through within cash. We're continuing to see cash in line with our expectations against that billing and against those price rises, so we haven't seen any deterioration in collection experience, despite the fact that prices are now significantly higher than they were 6 or so months ago. And the trend has continued into March. So as of this morning, we've collected over 20 million pounds in cash for the month of March. And very much expecting that the sort of working capital benefit that we see over the summer mitigates the challenges we saw at the back end of 2021 in terms of the additional commodity costs that we were paying out on those short-term markets. So just finally, this is a slide we cover at each one of our results presentations, just in terms of looking at the uses of the cash that we are generating. We've outlined already the investment that we intend to make in the next series, the Series A for the ZapMap business, which we majority own, as well as organic investment into our feed-in tariff system business, into feed-in tariff systems. There will be potential M&A opportunities to develop our energy services offerings, and Nigel will talk about some of the areas that we continue to develop. We have proposed a dividend for FY21, but against the backdrop of that organic growth and the potential opportunities and services, we see dividends as a lesser priority in the near term. So I'm now going to hand back to Nigel to talk a bit further around the strategic update.
Thank you, Rupert. Obviously, we're happy to take questions at the end if there's any aspects of the accounts you'd like some further detail on. There's quite a lot of disclosure already published this morning as well as part of our RNS. I'm just going to take 3 or 4 slides for each of the 3 areas that I outlined as representing Good Energy's future, just to explain our position and where we're going from here. And rightly, we should actually start with our renewable supply proposition. That obviously has always been core to Good Energy's consumer proposition, and that has not changed despite the sale of our own generation assets. We see ourselves as one of the few suppliers in the marketplace who will absolutely match the consumption of electricity by our customers with renewable generation. It's a very mission-driven position, core to our support for a cleaner and carbon-free energy grid, and it remains the case. I thought it might be helpful to try and visualize what that actually looks like. So on the left there, you can see a breakdown of our fuel mix, our power mix, if you like, for the last year. The only comment I would make on that is you can see that wind is by far the biggest single source of renewable generation that we buy from, that we source from. And whilst that reflects its position in terms of UK generation, it occasionally has caused some problems in a year like last year, where you get particularly still periods. And so if there's an opportunity this year to slightly reduce the proportion of wind in our portfolio, we should be taking that to better balance the risk. The core of our model, though, is really represented by the map of Great Britain on the right of the slide there. What you can see there is the PPA count by fuel type in each of the regions of the country. So the sharp-eyed of you will begin to spot that there's a greater preponderance of solar, for example, in the south of England as opposed to the north of England and Scotland, which tends to be more of a wind-based environment. But that is our hedge. Okay, we have over 1,900 separate long-term arrangements with independent generators, with funds who own solar parks, with farmers, with some of the businesses and community associations we've profiled over the course of the year on our website. And those are long-term agreements, often very deep-rooted, that we've been companies, individuals we've been working with for a long time, who allow us to source power at acceptable rates and also manage quite a lot of the risk we're facing in the energy market. There is a sufficient generation capacity in that group to power my home city of Manchester for a year. So there's a substantial proportion of UK renewable generation that Good Energy's customers support through those PPAs. And our commitment to that network is absolute. And if anything, as the business expands, we'll be expanding our buying from them. The supply market overall is a difficult place to gauge at the moment. It has been largely frozen since October, and many of the domestic customer switching sites are signalling they're not expecting much business at all this year. I think that probably is a fair reflection that we will see a more stable domestic supply market this year and beyond. There are far fewer competitors in it, and either regulatory change or just the economics of the business are going to make it much harder to price below cost to encourage people into switching. But I do think that consumer demand for renewables may be at something of a tipping point, and we will obviously see an increased emphasis on renewables, not just as an environmental issue in the aftermath of COP26, but also increasingly as an energy security issue in the aftermath of Russia's invasion of Ukraine and the need to reduce our dependency as a country on Russian hydrocarbons and the wholesale market for fossil fuels. And I think more consumers, as they begin to consider their energy choices, are likely to therefore want to know much more about the source of their power. That is certainly the case on the right-hand side. In the business market, there is now an obligation on businesses large and small to report their carbon emissions. That actually shows Good Energy's footprint for the last year in very detailed terms. And it's a very easy way for a business to improve its scope 2, as they say in the technical jargon, emissions. So not so much the energy they use in their core product, but the energy they use supporting their staff, possibly in staff commuting. If they switch that to renewables, there is a very considerable dividend to be shown very immediately. So I would expect increasing amounts of business demand, and we're very happy to fulfill that demand as long as it's from businesses who absolutely want to buy in to a renewable proposition and the element of price premium that comes with that. So I'd anticipate our supply business growing at a sustainable, which probably means low to medium single digits for a while, rate. And we don't actually want it to grow too much faster than that with energy prices overall where they are, because if you're on the hook for an increasing amount of wholesale power, that increases the risk and increases the demands on your working capital. So we will grow this in a sustainable manner. It's worth reiterating that that business is, whilst we are not by no means the biggest supplier in the market, we have about just under 100,000 customers on supply with us. We do have a strong operational track record and position. Kraken we've talked to you about before, it's the Octopus Energy developed system for managing domestic customers. It is fully in use, is enabling a much more efficient operation by Good Energy. So we have fewer staff in that area of the business than we did 2 years ago. Its philosophy, which is around fewer but better qualified call centre agents dealing with all aspects of the customer journey, is allowing us to drive very strong customer service scores. So we're one of the best rated energy suppliers in the market on that basis. And it also enables some of the innovation we've done in the last year in terms of new tariffs. When we last spoke to you at the end of the summer, we were in the process of just finishing our implementation of NSEC, which is a business supply system. Just as a reminder, business energy is bought on a different basis with different units to domestic energy. NSEC is now fully operational. And so some of the pauses in billing that we had to go through as we migrated those customers onto that system are now completed. So those customers have a digital portal in which they can engage with us on. And so our kind of billing migration process is now complete and robust. And we have 2 very modern billing and customer management systems for each side of the business there. Smart meters are an important enabler of innovative propositions in energy. They're also an important enabler of an accurate billing estate, and we've now got up to about 30,000 smart meter installations, having done 22,000 in 2021, particularly picking up as some of the COVID rules backed away. And then lastly, and perhaps something we've been a bit quiet about, ever since Juliet set up the business, frankly, we have been our own energy trader, which has enabled us to manage our risk appropriately and is very valuable in the current environment. We've added gas shipping, so that's effectively managing the precise amount of gas we need to buy in a given month to that process, because our gas shipper was one of the businesses that failed in the consolidation of the sector in Q3, Q4 last year. That was initially enabled through Barrow, a green gas partner of ours, but as of Friday, we've become our own gas shipper for all the meters in our portfolio. And this is all underpinned by very strong accreditation from highly regarded third-party accrediting brands. So we've talked on our customer service through Trustpilot. We're the only provider with all of its tariffs regarded as the gold standard in terms of renewables by Uswitch, and Which and the Consumers Association regard us as offering the greenest supply proposition in the UK. So underpinned by strong credentials and good systems and high capabilities, we have a robust supply business. The 2 areas of the business I see, frankly, growing faster and certainly expanding our footprint are the next 2 areas to discuss. So the first of those is decentralized energy, which we've defined there on the slide. It's worth reminding ourselves that whilst we may be a relatively small player in terms of energy supply, we're a much larger player in terms of decentralized energy and the administration of people feeding back into the grid. We think we have about a 20% share of the market there. So we're one of the major players in decentralized energy. And we would say that we have a broad portfolio of customers, both business portfolios and domestic, and that we have hard-won capabilities in this area. We have a very strong satisfaction rating. We have very strong word-of-mouth recommendation, particularly from solar installers. We have an opportunity, frankly, because very few of our customers in this area are also supply customers, but it's one we've got a position of strength in. And it is an area which I would expect to grow quite considerably from here. This is a graph of solar installations over the course of the last couple of years. And you can see a considerable pickup in rooftop solar even through last year. This will be further stimulated by 2 things. There was a tax break for both businesses and domestic customers in the spring statement in this area. And frankly, the very high cost of energy is causing more and more consumers and businesses to look at generating their own power. That is a trend, of course, we welcome and one we want to enable, and we're looking forward to supporting that. And we're doing so by innovating in terms of our proposition for this marketplace. So we've already invested in making it just easier for these customers to work with us. We can take automated meter readings, for example, from feed-in tariff customers for the first time, and that's cut the number of calls we get in by about half. Much easier for many people to do that in an automated way. And we're moving on in terms of a proposition away from just offering administering deemed and default payment, or deemed, I should say, payment types, into actually offering to pay people using smart meter data for what they've actually generated, which for most households, unless they're very heavy users of power, may well be a net export of power to the grid. So we think this is going to be a better proposition. It will go live in the second half of this year, and it is one that I would hope to be able to take some market share in the feed-in tariff market from. I suppose lastly, we're also seeing a lot of interest in anything from self-generation to supply to energy sharing propositions, and we are looking actively to partner with people to help us understand, engage in these markets before we kind of see where we can invest next. And then lastly, mobility. So if greening the grid is an important part of the UK's journey towards getting to a zero carbon energy environment, then transport is the other big category, and we see playing a major role in terms of just making it much easier to use electric transport as a key part of our strategy. More precisely, there is quite a growing ecosystem now around people buying and owning electric vehicles. We see ourselves very much playing in a world of specialist supply and services to make it easier to search or drive or plan or pay for your fuel. We see other people who we may well partner with or refer to playing in the infrastructure market. You need a lot more capital, you need a decentralized workforce to do installation, or indeed in selling electric vehicles. There are great providers in those areas, very happy to partner with them, but we'll leave that market to them. We are very much focused on innovative supply propositions where we can, and growing ZapMap, given its role in the electric vehicle ecosystem. And let's start with ZapMap, which is a reminder of we are the majority and controlling investor in. It's had a very good year. So its number of registered users has increased by 125%. And more impressively, I think in the graph, you can see there that it maintains a very high penetration of the electric vehicle park, despite frankly spending little to no money on marketing. So if you're thinking about what are the credentials of this as an online platform, well, it has very low costs of customer acquisition and is doing, I think, a good job of sustaining that. So therefore, we should realistically expect ZapMap to grow as the electric vehicle market grows in the UK. And you can read all sorts of projections about this, but as many of you will know, of course, given a combination of government targets and the high cost of fuel, most projections would see a 90% plus compound annual growth rate in electric vehicle usage ownership over the next 5 years. So ZapMap has sustained its audience and grown with the market. It was also the first year in which it was beginning to scale its business propositions. So first off, subscriptions. So ZapMap's a freemium model. Think Strava, think Spotify in some ways, which, yes, it offers its basic maps for free, but if you wish to use the map in your car dashboard, if you want to use some of the more advanced features, you need to become a subscriber. We have seen an overall 2% rate of users and subscribers, and perhaps more interestingly, a 6% rate of new customers subscribing, which is well on the way to what is in the business case and the information we're raising money for ZapMap with, which is a target of 10% subscriber conversion by December 2026. Now, depending on your viewpoint, that will seem like an ambitious target or a relatively small target. It is a much higher rate of subscription than the likes of Dropbox or Evernote, so personal productivity freemium propositions secure. We've got a lower rate of subscription than the likes of Strava secure. So we're in control of this to some extent. It depends how much of the proposition you put behind the paywall in some ways, but I think this feels like the right balance to both maintain that penetration of the EV market, particularly when we're not spending money on marketing, but also building out the strong recurring revenues of a subscription business. It also creates something of value that we can bundle. It means you can bundle it in terms of a new car sale, and that's a conversation we've begun with several car builders. You can bundle it in terms of a tariff in the future, which will make a more holistic electric driver proposition for Good Energy to give. So plenty of roads to travel on the subscription side. And we're also seeing good progress in terms of Zap Pay, which is the pay through the app proposition that they launched last year. There will be 9 networks contracted and live by the end of April this year. We're seeing perhaps a slightly higher rate of average charge from Zap Pay users, and we've now got to pretty decent coverage, particularly of the ultra-rapid charger market, which will mean that you can plan quite a long journey now, purely paying with Zap Pay. We think it's a better proposition even than contactless because it puts you in control fully. It gives you an expense management and history capability that going through your bank account would be cumbersome. It means we can provide data and sell data back to charge point operators. We're probably the most authoritative source of ZapMap in terms of EV usage patterns in the UK now. We're beginning to monetize that in a meaningful manner. And it also has enabled us to join forces with FleetCor, owners of the All-Star payment card, to basically take what fleet managers have had for years in terms of petrol cards, using cards to pay for it and then manage accounts, to do the same with ZapMap, which would mean that if your fleet is electric, your drivers can charge, but the bill can go back to the central bill holder. You can keep track on everyone's usage. And so that is one example where ZapMap is once again showing that it can build revenue streams to match the penetration of the market it has achieved. And there's a reason why, as we've said before, we will be looking to be cornerstone investors in its Series A fundraising round. That round is due to finish at some point during the next quarter. I would expect probably sooner rather than later. And a likely outcome is that we will invest alongside at least one strategic partner who can bring additional value to the ZapMap business as well. So plenty going on that side of the business. And where we can, we've supported it with time of use and other innovation for Good Energy customers in terms of their tariffs. So those are the 3 areas of the business we see ourselves investing in. We also see ourselves coming back to forums like this to report on our progress and very much aspire to increase the reach of Good Energy and increase the delivery of its overall mission, if you like, to get the UK to cleaner and greener power and transport. And we stand every chance of getting to well over 1 million households and businesses touched by this, we hope, over the next 3 years. So that's the end of the formal presentation. Mark, I'll hand back to you for notes and then we'll go from there.
That's great. Nigel, Rupert, thank you very much indeed for updating investors this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while Nigel and Rupert take a few moments to review those questions submitted throughout today's presentation, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet company dashboard. Firstly, thank you to all the investors that submitted questions during today's meeting and also those that pre-submitted questions. And Nigel, if I could just hand back to you to read out those questions and give a response where it's appropriate to do so, and then I'll pick up from you at the end.
Thanks. So Rupert, if you go to the Published tab, I can see those.
If you just click in the new and in the
new, is that what
yeah,
it's
sorry, new. The first one is from Mingwell M at 206.
Okay. So I will read out the question and then either Rupert and I will add some answer depending on whose specialism it sits in. So Miguel asks us why the disposal of the generation portfolio better prepares a company for a volatile energy market. Vertical integration provided a partial or total hedge. I'll summarise the answer here and then Rupert, you can build on it if we'd like to. It's worth remembering that the generation assets we've sold provided only 15%, that's 15% of the power we sold, and that was a declining proportion of our supply business over the course of the previous 5 years. They were somewhat peripheral to that. They were also peripheral to that because we had PPAs, long-term agreements with those assets, which, yes, when we owned them, was a slightly sort of odd internal arrangement. We have retained those PPAs, which means that we've not lost any of our power footprint. All we've done is release the capital from that. And I think that the number of PPAs, so 1,900 and growing, the breadth of generation type, so not just wind, but solar and anaerobic digestion, and the length of those relationships, so often 1 to 2 year contracts, means that we can be sufficiently hedged. We retain a very active origination team who are very well known in this market and continue to sign up new small generators. That's the core. That decentralized approach is the core of Good Energy's ethos, and it gives us a very strong hedge. And frankly, it's one of the reasons we've been able to navigate the extraordinary conditions of the power market in the last few years. And I think selling the assets when we did, frankly, was a very good deal for Good Energy's shareholders, because it locked in what is effectively a top of the market price for those assets and freed up that capital. Is there anything you'd add to that? Thank you, Rupert. That, I think, answers that question. So the next one is from John. For those who missed your previous announcement on ZapMap, could you tell us what percentage of ownership do you currently have, and what will be after the fundraising when all this closes? So we own 50.1, so just over the 50% mark of ZapMap at the moment. We have said that the plan is to raise roughly £7 million in a Series A, and that our base plan would be for us to retain either a majority ownership, if not that, then certainly sufficient management control to allow us to offer propositions to our user base and to enable the companies to move at speed. But plan A was certainly holding around that level, following our money effectively. I would expect it to close in the next 6 weeks or so. We're in final negotiations with 2 or 3 potential partners, all of whom have got sort of the necessary investment clearance and are very interested in the business. So there'll be more news from us on ZapMap as that happens. From John, what's the projected revenue and profit for the company's investment in ZapMap? So there's quite a detailed investment memorandum out there for people, obviously, who wanted to invest in that market. It's under NDA, so we haven't given all of the detail out there. But I would think about ZapMap as very much as a growth play, as I've described, and one that you'd anticipate coming into sort of cash positive territory in the course of 3 or so years' time. But there's a lot more detail in its published information memorandum. And then the next one, from John, could you specifically talk energy storage from wind farms? Something as a member of the public I wasn't fully aware of until recently was the issue that we have a massive issue around the lack of cabling to send power from wind farms into the grid. Is this an opportunity for Good Energy going forward? Can we store, or indeed help store, and then sell on when demand is needed? So Rupert is a seasoned observer of the energy market, and I'll let you take that one on.
So it is a significant issue. It's a significant issue when the wind blows too hard and generators have to effectively be told to switch off and have to be paid to switch off because the grid is unable to cope with the level of generation that is coming into the system. There is also quite a geographic challenge associated with it. So when Nigel was showing the geography of our wind farm portfolio, that's not inconsistent with the geography of the wind farm portfolio across the country at large. So it is more focused within Scotland and Northwest, and therefore there's significant grid capacity constraints in actually getting power, which is in one part of the country, to where demand may be needed in another. And grid scale storage is a potential solution to it, depending on where the blockage effectively is. If the blockage is getting from an individual wind farm to a point within the sort of central system, it may be more challenging. However, if there's a way of the constraint between north and south at times, then it potentially provides a solution to that. I think it's unlikely that we would be a provider of that level at that level of scale, given the capital demands of that. But there are ways which I think we can contribute on a more decentralized basis through the propositions and rollout of further solar and potential battery technology in homes and businesses that allow them to store electricity when it is in excess and use it when the demand constraints on the grid are higher. So opportunities.
I think it is one, yeah. And of course, the wider picture around the role of storage on the grid is something we're exploring all the time. Cracking will eventually enable electric vehicle as a storage battery in the home. So there was kind of propositional shift, I think, to come in that area too. John saying good update, thanks. It's Rupert, Russell, and Nigel. Do you see any further fallout in suppliers due to the wholesale volatility? Any vulnerability for good energy? So let's deal with us first, and then we'll talk about the marketplace. Whilst I don't want to be, throw all caution to the wind, I think two things keep good energy relatively secure. First is the strength of our balance sheet, so no debt, a cash balance, which means that if necessary, we can, cushion a spike in prices for a period because we have to buy extra energy in the wholesale market until we can get the money back further down the line. And then thirdly, a degree of flexibility in pricing, which not all suppliers have. We have business customers who, yes, they're often on 1 to 2 year contracts, but you have flexibility in what level you set that contract at. We have a derogation for our domestic SVT, so we don't have to stick entirely to the consumer price cap, which again gives us a degree of flexibility and protection. So that's why we would say we're able to survive. We're happily satisfying Ofgem to date in terms of all of their new requirements of energy suppliers. In terms of the market overall, there aren't that many left, which sounds like a glib answer, but it's true that actually if you strip out the white label brands of people like Octopus, there are probably somewhere in the teens of energy suppliers now, and there may be 1 or 2 who are still struggling. The thing to watch out for is things like whether people are meeting their regulatory payments on time. But I think the big shakeout has now happened because it was the wholesale period that caught everybody out. If anybody else is still trading, they've got a degree of either funding or resilience in their model. What will be interesting is, do we emerge with a different and more stable supply environment? Which I think we might for a considerable period. And certainly, if you look at what Ofgem are doing, that's what they almost want. In that, if prices do fall away quicker than we're expecting in the wholesale market, Ofgem will actually now charge an energy company who is taking on customers from another a fee in that, just to make sure that people don't come in and sort of undercut incumbents and therefore provide a disincentive to strong hedging practices. That's, I think, the main commentary I'd want to offer on the market. Here's Lee. We're all bullish on EV and believe it's the right approach. What do you specifically plan to sell to customers in terms of services and or products? So I think on the ZapMap side, we talked about it really, it's subscription and a payment product. On the good energy side, it is tariffs for EV owners. So we had some experience of that last year. We pulled them temporarily in the period of very high and volatile prices, just because having tariffs out there that encourage high usage wasn't necessarily a prudent thing to do. So I'd expect us to coming back with further green driver tariffs aimed at this market. And then as it develops, bundling ZapMap with those tariffs, and then looking at more flexible approaches to storage using your car or charging on the road using your good energy account. So plenty of opportunities for innovation. On the supply side, we just need to see a slightly less volatile market. David, revenue and profit targets for Zap over the next few years. With the data from Zap app, you see less usage of EV charging a bit higher. So sort of a few points to deal with there. We'll have an updated valuation point on ZapMap when we close the Series A, so we can take people through that. At the moment, some of the commentators on the company are talking about a valuation in the mid to high teens for the company, which is one that I'm reasonably comfortable with. We're not actually seeing any reductions in usage. I mean, it's an unfortunate situation that whilst this presentation is talking about the cost of electricity and gas, there is huge commodity price inflation in everything from heating oil to oil and petrol and diesel. And actually the economics of EV driving look better than they ever did. So we're not particularly seeing any reductions there. Again, the detailed breakdown for Zap is within the confidential investment memorandum that we've put out to Series A investors. I think having it in your mind that this is something that you would expect to be investing behind, so incurring a bit of a loss on for the next 2 to 3 years before it begins to break even and is capable of generating eventually 10 odd million in a few years' time is the way to think about ZapMap. It's a very different type of business to the core supply business. John, given increasing cost to businesses and consumers, how are these helping customers to cope, and any concern over bad debts? Rupert, John, talk about debt, and I will then talk a bit about help.
Sure. So, I mean, it's always an area of rigorous focus of us. We are concerned about bad debts. The higher commodity prices move and the higher bills to homes and businesses become, then it does obviously become a increasing concern. We haven't seen evidence of it happening yet. And as I touched on earlier in terms of the experience that we have in 2021, but we will be very watchful through 2022, given the widening cost of living crisis, inflationary environment that we are doing what we can to protect ourselves against bad debt, but obviously being conscious of the protections that wider businesses and consumers will need within this economic environment. Nigel?
Yes, I mean, obviously it's terrible timing that from an energy company point of view, and many of our customers, this has come on the back of COVID. So there's already a period of flexibility, particularly with some of our business customers who were effectively locked down and furloughed that we've been through. I think now we're in the process of supporting customers with alternative payment plans where we can, working with debt management charities in a handful of cases, offering a smart prepayment meter solution for people who want to budget in that manner. So we're doing what we can. I think those of you who heard my public pronouncements on the subject, and I've been unashamedly loud on it, frankly, we've been pointing out that the government's response to date is pretty inadequate, particularly for the bottom quartile of households by earnings. And we are lobbying very hard for better and further and more targeted support for businesses and consumers given the energy price. And then there's a longer conversation to be had around the way wholesale power is actually priced in this country, which tends to mean that the price of gas, which drives electricity generation pricing in the short term, is the price that dominates, which means that we're not even able to offer customers the benefits of renewables when they are there. We should take Jane's question and then maybe look at some of the ones that were pre-submitted, so we make sure we get to those. Jane asks how close we came to being taken over by Ecotricity. So we were very public, as we obviously have to be as a PLC on these. Ecotricity got the support of an additional 11% of the shares to go with their 25, which meant that their offer lapsed. They had an acceptance criteria of getting over 50% for that deal. And then the subsequent general meeting was very heavily rejected in terms of share voted, and only about 5 or 6% of the shares actually voted with Ecotricity on some of those motions there. So that is now something that we very much see as being in the past. Pre-submitted questions. So we can kind of cut to those from here. I know we had...
Are you happy for me to read those out, or are you happy for?
We lost them in the chat, so if you can.
Yeah, of course. Yeah, no, it'd be my pleasure. So the first question reads as follows: how will you be able to guarantee ongoing supplies of renewable electricity against a growing demand from current customers?
And I think in the short answer to that is through the PPA network. You saw the map I put up there. There's already 1,900 of them. It's a very good instrument for hedging forward against the market, and we have a good presence in this marketplace. We have a strong origination team and plenty of generators who want to work with us, either for the company's underlying mission or our track record in this market. And so, we are able to back off the demands for supply with PPAs and comfortable to do so.
Thank you very much indeed, Nigel. The next question reads as follows: as you do not use fossil fuels, will the problems with Russia affect your prices?
I touched on this briefly, actually, in one answer I gave a few moments ago. And so unfortunately, the answer is yes, because the wholesale price of electricity eventually is set by the marginal cost of the last generator to enter the market. Pretty much in the UK, you can guarantee at the moment that is either gas or coal. So that means that the wholesale price, particularly in the short-term market, is very high. And there are moments when we need to sort of top up from that market because the wind isn't blowing, for example. We are subject to those same prices if you watch the national debate on energy in the next couple of weeks, there's a government energy strategy due to be published. One of the things to look out for is whether there is any proposed reform of the wholesale market, which was really sort of fit for purpose in the early days of energy supply privatization in the 90s, but maybe does not suit a net zero ambition or a renewable ambition because it doesn't pass on the benefits of renewables to customers. It'll be interesting to see, and certainly we'll be arguing for reform of that wholesale market.
Thank you very much indeed. Turning to the next question, when will Good Energy offer off-peak or time of use tariffs to customers who are not already on these types of tariffs?
We did offer some in sort of summer period of 2021 as a new test. So we had either a sort of windiest days free test, which was kind of interesting intellectually, but maybe not so much for consumers, and then a series of time of use tariffs for cheap overnight electricity. We saw a good take up, and we saw a considerable switch of consumption of up to about 40% into the cheaper off-peak period. We just pulled some of those because we don't quite have the same level of data and understanding of usage in those tariffs. And that's important in terms of pricing them in the current market environment. But as soon as we get to a more stable period, I'm unfortunately expecting prices to stay high. If we get to a more stable period, then we'll be looking to reintroduce some of those tariffs again, with Green Driver, the EV owner tariffs, being the first target.
That's great. Thank you very much indeed. I am mindful of time, and I know we're coming up to the hour, and I know you have a schedule of meetings also today. I will shortly redirect investors to give you feedback, which I know is particularly important to you both. And thank you to all the investors who have submitted questions, and any questions that we haven't got round to, we will obviously make available to you post today's meeting in case there's any other responses that may be required. But perhaps before I redirect investors, Nigel, to give you feedback, if I may just ask you for a few closing comments.
Well, I would like to thank everyone for making time in their busy days to hear our presentation. It has obviously been an extraordinary period for the company since I took over last May, and I would absolutely commend all of the reporting we've put live today for anybody who really wants to understand what we've done in the face of the energy market and where we see our strategy going. There is a very high level of disclosure, and just as a reminder, it is all, the directors have an obligation to make sure it is a fair and balanced commentary on the year and on our prospects. So there's plenty to read if you're interested in it. I would like to really conclude by saying that despite the volatility, I think the company has a very exciting future ahead of it. I think it has a real role to play as renewables become not just part of the climate story in the UK, but also part of the energy security story in the UK. Good Energy has always played a pioneering role, frankly, in that, and I'm looking forward to leading the company into the next phase of doing so. We could not do so without such supportive shareholders in this year more than most, so I would like to thank the shareholders for their support over the last few months and look forward to talking to you in the future about the progress we're making.
That's great. Nigel, Rupert, thank you so much for updating investors this afternoon. Can I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the company can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Good Energy Group PLC, we'd like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.